Hi, I'm Bob French. Today I want to talk about banks, and specifically how safe they are, especially given the dislocation that the coronavirus has caused in the economy. We've gotten a couple questions about this, so I want to address it because it's a really fundamental question. People hold cash in CDs, or certificates of deposit, in banks as a way of keeping that money safe. Well, still getting a little bit of return on that. The bargain is that usually you accept a slightly lower interest rate for putting your money in the bank than you would other places in exchange for being as close to certain as possible that your money's safe. But with everything going on, some people are starting to get worried about that bargain. How safe are banks? Can you trust them with your reserves or just the cash portion of your portfolio? But let's focus in on the second part of that bargain, that short of the economic end of the world, your money is safe in a bank. So what's the risk we're worried about here? Well, the risk is that basically a bank will go bankrupt and take your money with it. And this used to happen somewhat regularly because banks operate pretty much on trust. Our banking system uses something called fractional reserve banking. It's an incredibly powerful system, but one of its fundamental characteristics, and the one that we care about here, is right there in the name: fractional reserve banking. The bank only has a fraction of the money that its customers have put in held in reserve. If all the bank's customers, or even just a reasonably big group of them, were to show up and ask for their money back, the bank simply wouldn't be able to do that. It doesn't have the money there. The bank uses that money to issue loans or simply invest to pay out the interest on their savings accounts and CDs. This is what happened in the bank run scene in It's a Wonderful Life. Everyone got nervous the bank would go out of business, so they wanted to get their money out before the bank ran out of money. They didn't want to be the last people in line that lost all of their money. But it's important to notice something here. It didn't matter whether the bank was in trouble or not. Simply a rumor that a bank was in trouble meant that the bank was actually in trouble, since no one wanted to be at the back of the line to get their money out. You probably noticed that I've been using the past tense here, and also that you don't see massive crowds of people running to the bank to get their money out. Bank run wasn't just a turn of phrase. Now, the reason for this is that the federal government guarantees the safety of bank deposits through FDIC insurance. FDIC stands for the Federal Deposit Insurance Corporation, and these are those stickers you see on bank doors. Essentially, the banks pay into a fund, and in return, the FDIC guarantees that if the bank goes under, then all of the bank's customers will be made whole, up to certain limits. And those limits are pretty high. Currently, the FDIC insurance covers up to $250,000 per depositor, per bank, per ownership category. So at an individual bank, your insurance would cover both a personal account with up to $250,000, as well as $500,000 in a joint account with your spouse. And you get that level of insurance at each bank you have accounts with. If you work with a credit union, you'll have the same level of protection through the NCUA rather than the FDIC. Now, technically, this protection is funded by the dues that the member banks pay in. It is insurance after all. But both the FDIC and NCUA are federal agencies. There may not be an explicit federal guarantee, but there's certainly a pretty strong implicit guarantee there. But to get to the point where that implicit guarantee would come into play, bad things would need to be happening. And bad things as in the near collapse of the global financial system, at least as we know it. In short, you can be pretty confident that your reserves and cash positions that you deposit with the bank will be pretty darn secure. Short of there not being an economy, and in that case you wouldn't be worrying about your bank account all that much, that FDIC insurance means that you don't need to worry too much about the stability of banks. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this, or any other questions that you would like me to address, just drop them in the comments below. You can also check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date with everything that we're doing.